Buying a home is a daunting process if you don't know what you're doing, and sometimes even if you do. For most people, one of the most complicated and time-consuming aspects of a home purchase is securing a mortgage. Just to be approved, you often have to provide several years' worth of tax returns, pay stubs, bank statements, and whatever else your lender deems necessary. But after you get approved, you still need to determine what kind of mortgage you want to get. Do you get a fixed rate or adjustable rate? 30-year or 15-year term? Today, we will be talking about what it means to buy discount points and how to calculate whether or not it's worth it. Mortgage discount points are a fee that you pay to your lender in order to buy a lower interest rate. It is a pretty straightforward concept. However, it is not covered in many finance classes. The cost of one discount point is equivalent to 1% of the amount being borrowed. For example, to purchase 1 point on a $100,000 mortgage, you would have to pay $1,000. To determine whether discount points are worth it, you have to consider a couple of factors. First, can you afford to pay for the discount points? Unlike a mortgage, which has payments spread out over the life of the loan, the fee for discount points has to be paid for upfront when you close on the loan. Second, how long do you plan on living in your new home? If you are buying your dream home that you want to spend the next 30 years in, then discount points are almost certainly worth it. However, if you are buying a transition home and only plan on owning it for a few years, then discount points may not be for you. Let's walk through an example to try to determine whether discount points are advantageous. Suppose John is buying a house and needs to get a $200,000 mortgage. The lender is offering John an interest rate of 3% for a 30-year mortgage. In order to bring the interest rate down to 2.875%, John would have to buy 4/10 of a discount point. This would cost $800 because 4/10 of a discount point costs 0.4% of the loan amount, which is $200,000. First, let's figure out the monthly payments that John would have to make without buying discount points. I'm going to use the Excel formula PMT to calculate this. If you would like a video about how to use finance-related formulas in Excel, let me know down in the comments. The inputs for this formula are the monthly interest rate, which is the 3% annual rate divided by 12 months, the term of the loan in months, which is 30 years times 12 months, and the loan amount, which is $200,000. This gives John a monthly payment of $843.21. Now we want to calculate John's monthly payments if he chooses to buy the discount points. The only change is that now the monthly interest rate is 2.875% divided by 12 months. If we plug in all of this information, we find that John will have to pay $829.78. By buying discount points, John saves $13.42 per month. Since buying 4/10 of a discount point on a $200,000 mortgage costs John $800, we can calculate that John would break even after 60 months or 5 years. With this information, John can now make an informed decision. First, he needs to determine whether he can afford to spend an extra $800 today. If he can, then he has to ask himself if he plans on owning this house for more or less than 5 years. If it is less than 5 years, then John should not buy the discount points. However, if John plans to own the house for more than 5 years, then he should buy the discount points. To get a more accurate analysis, you could factor in the opportunity cost of the $800 John has to pay today, but that is the topic for another video. Let me know down in the comments if you would like more videos on mortgages or finance in general. Thanks for watching, and always think outside the box.